brutal session on the markets today, particularly the JSE. The banks were down 3%, financials down just over 2%, the industrial market 1.7% weaker, gold shares down 1 3/4, platinum shares got knocked by 5%, resources down 3.5%, and the all share itself down 2.5%, closing the final day of an incredible week, 27,342. On the currencies market, the rand is 7.59 against the US dollar on its lows as the JSE closes, euro rand 9.39, pound against the rand 11.02. Euro dollar, look at this, worse for 18 months I think it is, maybe even 20 months for the euro against the dollar, 123.85 as we close. Dollar yen 91.90. The gold price was 12.49.5, suddenly turning tail 12.23, down $12 on the day. The platinum price down $19 an ounce to $17.12, and the oil price down nearly 2.5%, $79.52 per barrel. Overseas stock markets, carnage over there. FTSE and DAX both down 2 2/3%. Dow Jones, S&P and Nasdaq down between 1.4 and 2% across the board, but it's very, very choppy, very, very volatile. These numbers brought to you by our partners INET Bridge. Turmoil in the markets today, the euro going to 18-month lows against the US dollar, the gold price going to all-time record highs in dollar terms, triple-digit losses for the Dow Jones mid-afternoon South African time, all sorts of stuff happening. Deflation in Spain, that's another one. On the line now, from a hotel room somewhere in New York, is the Chief Economist of Investment Solutions in Johannesburg, but this time he's in New York. Chris, what's happening over there, first of all? What's your impression of New York? We spoke to David Shapiro a couple of days ago, and he said the place is booming. Are you getting the same sort of feeling?
Well, it's certainly a bustling place, as I say, everything. It's asserted that everything is bigger and better in the US, and it is. And that's as simple as it is. But you're quite right. I think the whole bailout of the euro, that occurred over the weekend and announced, for the markets on Monday, basically a whole lot of bankrupt countries giving themselves a bailout. Great. Adding more debt, which is the reason for the bankruptcy, onto more debt. And effectively, I think this is why you've got a major problem. I think the euro would have been more solid if there was no bailout. In other words, we apply the rules. But effectively, I think what's going to happen now is that the euro debt is going to, countries in Europe are still going to have an upward spiral on the debt. It's got no reason for any constraint at this stage if you're going to go for effectively a debasement of the currency, which was one of the things that, of course, is being examined here a lot more, is that the metrics around the UK and America look very much like Greece in many instances, or certainly will be there within a few years, and that's the concern, is that the euro is weakening against a rather dreadful dollar.
Yeah.
And that's why I think the gold price is now starting to reflect what I call a systemic hedge. In other words, the whole system is actually at risk because at some stage, where do you actually, what is your hiding place? The dollar's not really a safe haven. The euro is busy self-destructing because the rules are too difficult for the politicians to actually adhere to. And here we sit with a problem of bankruptcy. In fact, in many ways, rather pleased to be South African, where we don't actually have these problems. But of course, the problems here and the problems in Europe filter over into South Africa, unfortunately, whether rightly or wrongly. That is the reality.
Just looking at the markets now, Chris, I mean, this is a pre-recorded interview. You're in New York, and it's now 4:30 South African time. I'm seeing the euro at 124.20. In other words, €1 buying 1.2420 US dollars, the worst level for 18 months. And when I saw that announcement come out on Monday that there's going to be a package that basically amounts to 750 billion euros, and there would be coordinated intervention from the central banks and other authorities to support the euro in the world markets and to support the Greek bonds and the Spanish bonds and any other bond that came under pressure in Europe. It smacked of when I started in the markets, when Paul Volcker would try and defend the US dollar. You knew that was a ticket actually just to go the other way, because unfortunately, the hedge funds and the market is bigger even than the central banks and the European Union, etc. And I can see right now that those hedge funds are having a go and testing the resolve of these authorities. It can only end in tears as far as I can see.
No, exactly. I think even if the hedge funds were not, the economic reality is that when you start to build pillars of support, under your system, and those pillars are made of jelly, it's not going to work at the end of the day. The problem is that the country's government expenditures are exceeding their taxpayers' ability to support it. And you're getting an increasingly difficult situation where effectively the consumption spend in an economy is overwhelming the ability to actually produce the wealth to support it. And governments are turning to debt and printed money to do so. This is certainly going to end in tears. The ECB blinked, I think, over the weekend. The various ministers of finance blinked, and they will be at the receiving end. This package is a mistake and will be seen as a mistake. But the one irony is that the weakness of the euro does take some pressure off from a point of view of exporters in Europe, which are, got a stronger manufacturing base, ironically, than, say, UK or US. And it reduces the pressure for the euro to actually fracture. Strength could have fractured the euro because of countries like Italy and France not being able to cope with the strength of the euro. But at the end of the day, a too-weak euro means, will countries like Germany and the Netherlands actually want to ride that roller coaster down. And they may actually opt to say, the weak ones can have it, and rather actually opt out because they've already experienced the high inflation. But effectively, I think there's an increasing recognition that the system itself is a problem. There's just too much debt in it, and these measures are basically taking you down a very unsustainable path, and in a sense it takes you further down a point where you can't easily stop and reverse. It's almost like taking one-way street down, and I can't help thinking about other times when you have had disasters in individual countries. You say, why did the authorities just keep going in, say, for instance, Argentina or Brazil, when they went into hyperinflation? Surely it's obvious that they needed to do this, that, and the next to stop it. And I think it's because you've taken those decisions, you eventually cannot, because it's too painful to go back, back and reverse the path that you've taken. And so it's almost like you're going down one of those, profligacy avenue, and it's a one-way, and you're just putting your foot down harder and harder.
Chris, do you think the market's reaction today is a sign of things to come? In other words, do you think that we're going back to the bad old days that we saw a year, 15 months ago, whenever it was, where the markets really took a nasty hit? Because I'm just getting a horrible feeling that there's a lot of volume going through here over the last week or so on the down days, and we are going to see a revisit to those dreadful levels, i.e. 6,500 on the Dow and 17,000, 18,000, whatever it was on the All-Share.
I fear that is possible, but I think with one big exception. 2 years ago, bonds proved to be a safe haven, and this also might be an area that you have equities collapsing because bonds are collapsing, and you have to reprice your equities because of high discount rates. That could be a problem. Now, we've seen the US 10-year and the German 10-year still act as safe havens, but when those yields start to rise and the stock markets fall, I'd be very, very careful. It's almost like you need your gold in your bank beans and hole in the ground, and you just hope that you can attack.
Don't forget the bottle of wine, Chris. We'll have to leave it there. Thanks so much. Enjoy New York. Chris Hart, Chief Economist at Investment Solutions in New York City, the Big Apple.